Imagine building a diversified portfolio on your own. You'd need to simultaneously buy 50 blue-chip stocks, a commercial skyscraper, and a functioning toll road. For an individual trying to do this directly, you immediately hit a wall. You lack the hundreds of millions of dollars required. You likely don't have the specialized expertise to value a power grid or manage a high-frequency trading strategy. And even if you did, you lack the legal framework to acquire these mega assets. The workaround to this problem is a structure known as a collective investment vehicle. Instead of one person trying to buy a skyscraper, these vehicles pool money from thousands of people into a single, legally recognized trust. By pooling resources, that massive, unattainable portfolio is carved up into fractional units. You buy a few units, and suddenly you hold a proportional stake in the entire basket of assets. This mechanism takes an isolated retail investor with limited capital and instantly upgrades them. By merging funds with thousands of others, you gain the buying power and market access of a massive financial institution. The most accessible entry point into this system is the mutual fund. These funds are designed for mass participation, allowing you to buy into a highly diversified portfolio of stocks and bonds with as little as 500 rupees a month. Because the pool is so large, the asset management company running the fund benefits from economies of scale. They can execute thousands of trades, manage complex debt instruments, and negotiate fees down to a fraction of a percent per investor. As these funds evolved, they introduced factor funds, or smart beta strategies. Instead of a human manager picking stocks, these funds use quantitative rules, systematically buying blocks of equities based on mathematical filters like price momentum, low volatility, or deep value. But equities and debt are only part of the financial ecosystem. Many investors want cash flow derived from physical, real-world assets rather than paper contracts. This is where real estate investment trusts, or REITs, and infrastructure investment trusts, InvITs, come in. They take highly illiquid assets, like shopping malls, warehouses, and power grids, and convert them into liquid units that trade on a stock exchange. When you buy a unit of an InvIT or a REIT, you are entitled to a share of the actual rental income or toll collections generated by those physical properties, distributed as a stable, regulated dividend. These vehicles remove the friction from the market. Anyone with a smartphone can actively trade complex algorithmic stock strategies and commercial infrastructure projects while waiting for their morning coffee. Beyond the public markets lies an exclusive tier known as Alternative Investment Funds, or AIFs. These are strictly regulated, privately pooled vehicles built specifically for high-net-worth individuals and institutions. The barrier to entry here is steep, requiring a minimum investment of 1 crore rupees in India. This capital targets non-traditional private markets that regular mutual funds cannot legally touch. The regulator divides them into 3 categories. Category 1 funds inject early capital into startups and social ventures. Category 2 focuses on private equity and distressed debt. And Category 3 operates complex hedge funds using leverage and advanced derivatives. The trade-off is straightforward. You lock your money away for years and accept significantly higher risk in exchange for aggressive, customized strategies that aim for massive returns. But whether you are looking at a highly liquid mutual fund, a real estate trust, or a secretive hedge fund, they all run on the exact same legal chassis, a SEBI-regulated trust structure. The sponsor provides the initial capital to create the trust. The investment manager makes the actual decisions on what to buy and sell. And crucially, an independent custodian physically holds the assets in a vault, completely separate from the manager, to prevent fraud. Whether your portfolio is worth 500 rupees or 10 million, the legal machinery standing between your money and market fraud operates on the exact same principles of governance and separation of powers. Looking across this entire landscape, the stark contrast between a basic index fund and a Category 3 alternative investment fund proves there is no universally correct way to invest. Your goal isn't to force your way into the most exclusive tier. It is to select the specific vehicle that matches your current available capital, your need to access cash quickly, and your capacity to endure market volatility. As your net worth grows and your financial needs become more complex, the industry has engineered a purpose-built structure waiting to deploy your capital at every stage of your life. Understanding this ecosystem changes how you view wealth creation. You stop struggling to afford individual bricks and start buying strategic shares of the entire architecture. collective investment vehicles democratize scale. They absorb the crushing complexity of the markets and unlock the world's most powerful wealth-generating assets for anyone willing to participate.